During COVID, for example, a lot of funds kind of had a hard time to invest without actually meeting with founding teams. For us, it was business as usual.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast. And today we have Sergey Gribov with us. Sergey is a technology entrepreneur and investor with more than 20 years of experience. He's a partner at Flint Capital, a $250 million Boston-based venture fund that invests across Israel, USA, and Europe. And all that while having a distributed remote team in all these three regions. In this episode, we talk about Sergey's story and how he started investing, what they look for in startups at Flint Capital, trends and current market situation, perspective on US, Israel, and Europe markets, need for founders to diligence the VCs, how they operate a VC fund investing in three different regions while operating all remote. So without wasting any time, let's dive straight in. Hey Sergey, so good to have you on the VC 10X podcast. How are you doing?
Thank you for having me. Doing great.
Yeah, pleasure hosting you. So to start things off, can we first have your story and how you started investing and got into venture capital?
My background is originally technical. I used to do programming, operations, cybersecurity on more technical roles. At some point, I was like VP R&D, CTO at different startups. I actually worked at startups all my life. Never worked for big companies. And at some point, I was thinking about what do I want to do next. I was in like several startups, part of a founding team, top management in terms of technical side, and I kind of decided what I want to switch more to business side, kind of switch to the dark side. Basically went to MIT, did business degree, and at some point started to do angel investments. It kind of started kind of half accidentally. I was part of a founding team at Vivox, and many years later, I kind of helped the guys to organize management buyout from VCs. So that was my first angel investment, which turned out very good. We bought the company from VCs and sold it in 19, I believe, about 5 years after we bought the company for $100 million. So everybody got very nice multiples. It was more than 20x. And at some point, I was talking to Flint and started to work at Flint about 7 years ago. So I kind of transitioned from angel to VC world.
Yeah, that's certainly very interesting. So while you're investing at Flint, which is now a very reputable, VC fund in itself. So at Flint, so how do you look at different deals that are coming to you? On what basis are you evaluating them, right? So can you give us a glimpse of that?
Sure. So it's pretty standard. Most of VCs looking at the same things. Especially in the early stage, the main thing is the team. Because frankly, all you have at very early stage is team and vision. So you want to see big market product, etc. But team is the most important one, because in many cases, when it's really early stage, the company will pivot, will change a little bit what we are doing. The only thing which will be left from the beginning is the team. So it's all about execution. But in general, you're looking at the team, you're looking at market. You want this market to be big enough, because especially it depends on the strategy, but for us, it's important to see potential to build $1 billion company. So you can't really build a big company in the market, which is just a couple hundred millions. So you want to see the market is big, you want to see the pain people are solving, and you want to see some kind of competitive advantage. You're looking at competitive landscape, what's out there. But I would say the team is by far the most important thing.
Yeah, certainly. And while you're deciding and evaluating these companies, how are you coming to the right valuation for these companies? Does the fundraising environment also play a role in what valuation is given to a company?
So it's a tricky question because, frankly, you do look at different multiples and comparables, but the truth is it's always about the market. So you have regular market forces, supply demand. The supply are startups, the demand is money. And if you have way too much money chasing startups, you see valuations go up significantly. In today's market, when there is not that much money available, valuations are dropping like a stone in many, especially in many areas. So when we look at a deal, I'm trying to do things with what makes sense. I'm trying to see, especially early stage, you don't have any traction in most of the cases, so you can't even apply multiples. So what you're looking at how much money company actually need to get to the next stage. I always like to ask question, what's the next round will look like? Because in many cases, uh, people don't think about it. We kind of think, okay, I need X amount of money for the next 2 years, and it will take me somewhere. But it's usually a very good idea to look what the next round will look like, because that will kind of give you information how much money you need, how much runway you need to get there. And also, in many cases, next round it's much easier to value because you're supposed to have some kind of traction. So multiple supply, you can look at comparables, etc., etc. And then you kind of trying to go back from the next round because you want to be able to have at least probably 2 years of runway. You want to be aware one of the mistakes people are doing is they saying, okay, in 2 years I will be at X ARR. Now the problem is you're not going to raise round in 2 years. You're going to raise round in a year and a half because it will take you another 6 months to do it. So you need to look at the numbers where you will be in a year and a half, not 2 years in this case. So you put all of this together and you kind of figure out what's the right amount. Usually, what it comes down to every round is plus or minus about 25 to 30% dilution. And in many cases, that's how you kind of come up with valuation for the round. But it's like always different factors.
Yeah, certainly. And let's talk about a particularly successful startup you invested in the early stages, and what factors do you think contributed to their success?
So we were lucky. We invested, for example, in the first fund. We have three companies which are fund return companies. We were investors in WalkMe. It's an Israeli company. Did IPO on Nasdaq a couple of years ago. We're also investor. We led a round for Socure, which is a very successful US company. The last round was at 4.5 billion valuation. And we're also investors in Flow Health, which is by now number one up for women's health. We actually have, by all metrics, we number one up in whole wellness category now. So, with the example of successful companies, I think each road is different. So, for example, in case of Socure, we led the A round. The company is solving identity problem for many fintechs, banks, our industries too. So the company is very, very heavy data science company. Basically, quarter of people who works at the company are data science people. So it's very deep tech. But for example, in their case, their main customers are banks, at least at the point when we invested, and we were still struggling to close their first big bank. We had a lot of smaller deals, and it's a hard road. It's like in many cases when you try to sell to big companies, especially to banks, you're talking about sales cycle 10 months to a year plus. So it's very, very kind of long sales cycle, very hard to convince bank to take some technology from small startups. So it took them a while, but once we closed several first big customers, it was way easier. So they started to grow very quickly at some point. And in their case, the reason for that was also what we are by far the best solution in the market. Basically, nobody come close, and it's very easy for these guys to calculate how much money we're gonna add to their bottom line if we do better fraud detection, better KYC, etc. So at some point, the company started to grow significantly. Another thing which actually added a lot in the eyes of investors who invested in the company later on was the extremely big NRR, which is net revenue retention, which means basically every customer we have was adding every year to their check. So somebody who would start with 1 million a year, next year would be 1.5. In a year, it would be like 2.5 million, etc., etc. So in addition to growing to new customers, you're also growing in existing customer, and that was like adding to bottom line.
Yep. Yeah, certainly. That seems like a very solid business where your existing customers are also growing and your ones are also coming in, right? That's great. And now let's talk about, are there any trends in the startup ecosystem or VC ecosystem that you're excited by these days? Would love to hear
So
more on that.
so right now, obviously, we're in like downturn. The amount of money available to startups dried up pretty significantly last year, and it continues to dry up. The number of what I see in the market right now, the number of like early stage deals is lower and valuations are lower. A rounds, same thing. B rounds, we have significant drop in number of B rounds. I think it's more than 50% drop. The valuations during B rounds also dropped probably by at least like 50%. The growth rounds like C and above are virtually not happening. It's like there are some single companies who are very successful. Like we have very good company Adaya, which just did like 25 million round, and it was competitive. We had several term sheets, but I would say it's exception because the company is really exceptional. They growing at, I would say, crazy rate. I mean, it's I don't want to give out any numbers without talking to a company, but like they growing really fast. So some rounds are still happening, but the number of rounds are sharply down, and you have to be really exceptional in order to get outside capital. A lot of companies are doing inside rounds, like extension rounds, with idea to get to extend their runway by a year and a half, 2 years. Some of these companies are really good companies and they will be probably successful, but I think a lot of companies will probably be in really bad shape. I expect by the end of this year, we'll see a lot of closures, a lot of companies will go down because we just can't raise outside capital. So I wouldn't say it's exciting. From another side, I think it's healthy for the ecosystem because last several years were just way too crazy. People would drop money on you. You would see companies with like 200-300k revenue raising at like 100 million valuations, which are it just not healthy. So I think some kind of reset would be good for the market. But in terms of fundraising,
Yeah. Yeah.
yeah, and obviously you have trends. I mean, the trend du jour right now is anything related to LLMs, ChatGPT, and
Right.
others. And I think it's a great technology. I think there is a lot of hype right now, and probably every second startup pitch I'm getting now have something to do with ChatGPT. I
Right.
think we will. I mean, the technology is certainly going to change a lot of things. So basically, right now, if you're not using any AI or LLM technology, you're probably going to be obsolete very soon. So I do
Yeah.
see a lot of people are using it. The question is, a lot of people are just doing kind of wrappers around ChatGPT. I think that's not an interesting business proposition, but I do see some
Right.
companies doing very interesting stuff with it.
Absolutely. And talking about the current market condition, do you think that this is just a part of the market cycle that keeps going? So, are we going to be back to where we were 2 years back, or is this the new normal? What do you think?
So first of all, the place we were 2 years ago was not normal. You had a situation when during like 4 or 5 years you had interest rate at zero. You had so much money floating around. What it was just overheating the system way too much. So I wouldn't say it was normal. I think what we see today, I mean, different numbers. It's not clear. Nobody knows what actually the amount of dry powder, how many deals are doing people doing now, because a lot of like deals are not announced. But I think from the numbers I've seen, we now probably somewhere around like 2018, 2019 in terms of valuations and like amounts of investments, which is probably way more normal when where we were in 2020, 2021.
Right.
So I think it's way more normal. I think also one of the problem I see is, at least in a lot of fintech startups, a lot of fintech startups build, which are started during the time when the interest rates were zero, build built their business model on the premise what the interest is zero. Now, a lot of these business models just don't make any sense in today's environment, and a lot of these guys are in really hot waters because they have to change their
Yeah.
business model completely, or otherwise it's just never going to be any serious business there.
Yeah, absolutely. And Flint Capital is a VC firm that's investing across three different geographies. Like one is US, of course, and then Israel and Europe, right? So, how do you think that these three markets are different from each other, right? So, what's your view on that?
So, first of all the companies we're looking, we're going after US market. So, if we look at company in Israel or in Europe, we would look at the company which is going after US market, because we believe what the US is by far the biggest market, the most competitive, and if you're successful here, you will be successful later on in other places in the world. So, from the market perspective, it's all the same. Uh, I invest a lot in Israel. I love Israeli ecosystem. It's a great ecosystem which developed in the last 15, 20 years to be probably the second best ecosystem in the world after Silicon Valley. Actually, if you look at per capita numbers, per capita, there are like 5 to 6x more venture money per capita in Israel than Silicon Valley, or startups in Israel than Silicon Valley. I love the ecosystem because you have you have just great pool of talent. You have a lot of people who've been there, done that, very experienced, and they're also very collaborative. What people don't realize in Israel, it's extremely collaborative environment. Even I've seen even founders of directly competing startups talking to each other and kind of exchanging notes. People love to help each other. People love to help. Like successful founders are usually advising a lot of first-time founders. So I think it's a great ecosystem. The amount of venture capital which goes there also grew significantly. Actually, that's a little bit problematic in the last several years for Israel because there was just way too much money going on there, which drove valuation, salaries, etc. They just skyrocketed. So it created some of the problems. So in that respect, what's happening now is actually very healthy for Israel too. And the ecosystem actually, one of another kind of indicators of the ecosystem where in the last 5 to 10 years, I've seen a lot of M&A deals which are happening inside Israel. So basically Israeli company buying another Israeli company, which makes ecosystem kind of self-sustainable, etc. Europe, I think there are a lot of interesting things going on in Europe too. You have good technical talent. You have a little bit less people who have experience in startups, but kind of more and more people are getting there. You have by now you have a lot of successful European companies who are successful globally, not just in European markets, successful in the US too. And I think the trend will be there, especially with COVID. Frankly, the whole world got a lot flatter. Basically, by now it doesn't really matter where you are in the world. We actually, as a fund, we also run completely distributed shop. We remote first. Never the whole team never actually worked from single office. So in that respect, we kind of getting the best of both worlds. I live in Boston. We kind of local here, but from another side, we have presence in Israel. We have presence in Europe. So it helps us to work with startups there.
Yeah, that's very interesting. So, do you have people on the ground in all these three markets: US, Israel, Europe?
Yeah, we
Great,
have office in Israel. We have office in Europe. Yeah.
awesome. And you have leadership teams spread across these different
Yeah.
regions, is it?
Yeah, so we have
Oh,
three
that's great. That's
partners,
great.
two in Boston and one in Europe, actually. And I lived
Great.
in Israel for many years, so I speak Hebrew. People know me there, so I'm usually
Yeah.
in Israel every couple months. Plus, I have principal who is local there. We have office, so we have good presence there too.
Yeah, that's great. And let's talk about that aspect that how are you like running a VC fund completely remotely? And you've been doing this for like quite some years now, right? So how's that experience like doing this entirely remotely? Is it there's a lot of text conversation happening, or do you have a lot of meetings? And there are time zone differences as well, I believe. So how do you manage around all these things?
So we have basically a lot of work is done on Zoom. We have our weekly meetings. We have a lot of meetings between like team members. So we're a fairly small team. The investment team is just 5 people, 3 partners and 2 principals. So we're in constant communications. We're talking over the messengers. We have every week at least a couple of Zoom meetings. So I think communication is not a problem, and we usually meet face to face, plus or minus every quarter, which helps too. I think it helps a lot. What we are running our processes completely remotely. So when we talk to the company who is also doing it remotely, and more companies now have distributed teams, we understand their pain. We kind of understand how to work with them. So I think it actually helps a lot. During COVID, for example, a lot of funds kind of had a hard time to invest without actually meeting with founding teams. For us, it was business as usual. So for us, the way we work, usually at least one of the partners meet face to face with the company at some point before we do investment. But most of our partners are usually meeting with the team just over Zoom. So you're kind of used to this type of communications.
Certainly, that's super interesting, and glad you shared that with us. And I think that also gives you the liberty to invest across maybe a wider region inside the US and also across the world as well. Companies targeting US. I think that the market actually opens up by not being, regionally limited,
Yeah.
right? So that's great. All right. So my last main question to you before we move on to the rapid fire round, and this one is about what will be your advice for founders seeking funding in the current difficult fundraising environment?
So, given the environment, it's just hard. So you need to focus on like being very capital efficient, get to traction as quickly as possible, and basically show really good traction. In general, my like one of the things we really proud, we're very founders friendly. We even were chosen as one of the founder friendly funds by Inc. magazine, etc. But one of the things I always say to founders, make sure you do your due diligence on investors, because it's not just money. Money is like, what I love to say, is kind of ultimate commodity. It's all green. But whoever you choose as your investor, you're going to be stuck with them for lots of time. It's usually, especially from early stage till the exit, it's usually 7+ years. So it's very important to figure out who your investor is. I always say, talk to their portfolio companies, figure out how these guys, girls behave, how they help. Important thing, how they behave if things not go as smoothly as you hoped for. Basically, do as much due diligence on your investors as you can.
Absolutely. I love that take. And I think certainly that's something that more founders need to emphasize on. I think for most founders, I think the battle is getting funding. I think that they think that that's where the battle ends, and they're just chasing any money that they get in the bank, right? But I think there can be a lot of bad money as well, which can actually be detrimental to your business as well. So I think founders need to start thinking about that aspect as well. And I think you need to be in a certain place that you're at a position where you can actually pick and choose your right investors, right? If you're desperate, then of course you'll take any money
Yeah.
that there is. But if you're in a good position, you have maybe 1 year runway left, then you can sit and pick and choose, right? And do your diligence as well. And then you're in a good position to raise funding from the right investors, right?
Yeah.
Uh, Great. Awesome. So let's now move on to the rapid fire round, wherein I'll ask you five quick questions about the fund, and you have to give 5 quick answers. Sounds good?
Sure.
All right. So the first one goes, what are the sectors and regions you invest in?
So we invest, we have fairly broad and kind of focus in terms of sectors. We do both B2B and B2C. We do fintech, cybersecurity, digital health, DevOps. But we will look at pretty much anything. We don't have a lot of expertise in hardware. We don't have a lot of expertise in something which would require FDA approval. So that's something we wouldn't do. But besides that, it's pretty broad. And geography-wise, we tend to do a lot Israel, Europe, and US. But in general, we don't have limitations. So, like last week, for example, we seriously looked at a company in Australia. So we can theoretically do it. I would guess with somewhere in Asia or Australia, it would create some kind of logistical problems because just time-wise, it's very hard to communicate. But in general, not kind of we're not focused
Sure.
on Asia, but we're happy to take a look at stuff. Yeah.
Yeah, that's great. And what's the typical stage of investment?
We usually invest early stage. I would say sweet spot is seed. Sometimes we would put in first check in the company, would go as early as pre-seed, and we also do A rounds. Usually, kind of early A's. We don't like big A rounds, but something like a smaller A.
Yeah, and what's the typical check size you put in?
So check size anywhere from 500,000 to five as a first check, and we reserve about half of the money for follow-ons, which means we would probably put pro rata or super pro rata at least couple rounds, and on top of it, we also have new opportunity fund from which we can put bigger checks, usually in our portfolio companies, so we can follow on for fairly
Yeah,
long time.
certainly. That's a good approach. And where can founders apply for funding?
So it's very easy to find us. You can find our emails, website, etc. We do get a lot of cold outreach, although I usually say what it's probably a good idea to find common connections and have a warm intro. But I try to answer emails. I not always, I can't promise I will answer because I just have so many of them. Uh, but anywhere, email, LinkedIn, any channels of communications.
Absolutely. And last one is, where can our listeners follow you?
So you can find me on LinkedIn, you can find me on Twitter, all these places.
Yeah. Yeah, I'll make sure to put all those links in the show notes below so that our listeners can get there easily. Thanks so much for coming on. And it was a pleasure hosting you, Sergey.
Thank you for having me. It was fun. Thank you.
Thank you.